Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. You can join Brian Curtis and myself for the stories making news and moving markets in the APAC region. You can subscribe to the show anywhere you get your podcast and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.
Leland Miller joins us now, CEO of China Beige Book, to take a closer look at China's new stimulus measures. So, Leland, thank you for joining us here on the program. Do you like this shot of adrenaline that the Chinese economy is getting? One, do you think it will work? And two, as a sort of tack on, will there be benefits for the U.S. economy as well?
Well, there's a couple different aspects of this. So, you've got some big moves on property. You've got them on credit, and you've got them on stocks, and they're all trying to do very different things. Will anything on credit work? Very unlikely. Everyone's excited by the idea that they're going to be chopping the rates down, cutting rates on all these different measures and potential benchmark rates. What's actually the key here is that, and we've tracked this for years now, is that cost of capital has been going down in China quite considerably since the beginning of 2023. So rates reported by businesses have been going down and down and down. And the reaction to that has been absolutely nothing. Firms do not want to borrow because they look ahead at the future and they see everything is gloomy right now. And until they have a sense of confidence returned, they're not going to want to borrow. So the idea that they're going to be cutting capital, cutting the cost of capital more, isn't something that's probably going to have a very big impact. Now, stepping in on property and supporting some buying can set a floor in certain things. But I think that this is the key. This is about setting a floor on the economy. It's not about reaching a new ceiling. And I think that's what investors are missing.
So in terms of sentiment, how much of this has to do with the fact that when you're stuck in a deflationary trap like this and population sees asset values continuing to go down, you have really less incentive to kind of try to catch the falling knife? I mean, I think that's the proverbial metaphor here, right? How much of what we're seeing now is tied to that?
No, a huge chunk of it. I mean, a lot of what they're doing right now is trying to improve sentiment, but sentiment is really what's stopping any improvement in the economy. If you look at what's been happening in the property sector, it's been intentional. They have been trying to deflate the property sector, but it's very tough for Chinese households who have 70% or so of household wealth in property assets. So when they see these falling prices, they're not very happy and they don't want to go out and spend. They also see what's happening in the stock market. The stock market's been going down, which makes them feel even poorer. So it's a whole bunch of different things that haven't been going well. None of them are catastrophic to the economy, but all of them are impeding a more significant recovery. So what Beijing's trying to do right now is step in and just do enough to set a floor so they could focus on things that they care about more and don't risk some sort of doomed confidence loop.
I'd say that some would say, they're trying to rebuild confidence. They need to get confidence going. They need to get the animal spirits going. And this was sort of an across the bow, pretty big move here. So let's give it some time and wait and see whether or not it's putting a floor or stoking confidence. I mean, there's quite a gap between the two. We had a guest on yesterday, Min Pei from Claremont College. He was saying that it's really more about confidence in political leadership and in policy making, and that it's lacking in China now. Do you think it's going to take some time for that to get restoked?
Well, again, one of the things that's been happening over the course of the last 5-10 years is that the party has become more and more of the state, more and more of the economy, and Xi Jinping in particular. So if things are not going well, that makes the party look worse. It makes Xi Jinping look worse since he's head of everything. He's head of the party. He's head of the state. He's head of the economy. So there is a political aspect to all this. I think right now when the Chinese leadership is looking at their economy, it has had a lot of troubles in 2024, no question about it. But I think what they're really worried about are broader, more significant national security issues. They want to build a domestic chip ecosystem. They're worried about supply chain resiliency, U.S. and Western leverage over their supply chains and their technology and their payment systems. So they're looking at all these big things. And then, when it comes to GDP targets, this is the focus mostly of Western analysts. Xi doesn't want the economy to go down the toilet, but I don't think he spends his night worrying about whether they're going to hit 5%. They have to do just enough so that they can set a floor, make sure that things are not looking too terrible, and they can go about their way focusing on things they truly care about.
It's interesting. We had a story on the terminal earlier today highlighting the fact that China's over-the-counter crypto brokers have been attracting unprecedented inflows over the last 3 quarters, ending in June. I think the total was over 75 billion. It's obvious a reflection of a lack of confidence here. But I want to go to a note that you kind of shared with us. You write, in no way is this a bazooka of any kind. Okay, let's accept that. What does a bazooka look like?
Well, bazooka would be something similar to what they did back in 2009, 10, 11, when they just sort of unleashed the floodgates and they went big fiscal. They built a lot of things. A lot of people have been waiting for China to just realize, or Xi Jinping to realize the error of his ways and to say, you know what, we want these higher levels of growth we had before. We want these investor returns to go back up. We want to return the old stimulus playbook. Beijing has moved on. There's a different economic, sense of governance right now. There's priorities have changed. The stimulus playbook has changed. So right now they're looking at much lower levels of growth and focusing on these national security priorities that are really front and center. So I think what investors would love to see is some large fiscal package that really got them spend. But they do not want to do that. They think that this big deficit spending is a threat to the economy, because it's a threat to the party, because it's a threat to the economy. So I think the prospect of them going bigger outside of a break the glass emergency, it's just something they do not want to do.
So something I asked you about right at the outset was whether or not this could be positive for the U.S. economy. It seems like you're saying it's probably not going to be very positive even for the Chinese economy, much less the global economy or the U.S.
Yeah, these aren't things with major implications abroad. I mean, what is important for going on in the Chinese economy right now for other countries, or for foreign firms? It's the manufacturing platform. It's the new quality productive forces that they've been talking about, which is they're going to want to produce a lot more and they're going to export a lot more, which is a politically sensitive topic because they're talking about, despite the fact that they've got these enormous trade surpluses and enormous goods surpluses, and specifically, they're going to export more and more and more to trading partners, and that's going to cause political friction. And so that's really the dominant issue right now when it comes to China's exports and China looking abroad and the global the global view of China. A lot of these things that happen in the property sector are not relevant to the global economy. If they did some sort of enormous building program, yes, you'd have a commodities demand go up, and that could be relevant. But like I said, that's not what they want to do, and we certainly don't expect it.
All right. Thanks very much, Leland. Leland Miller, CEO of China Beige Book. Richard Harris, CEO of Port Shelter Investment Management, with us live here in our studios. So, Richard, we had these broad measures in China. We can debate a little bit about how big they were and whether or not they will be enough to reverse the Chinese economy's slowdown. But there are some that are calling for more of political backing as well. So a lot of this came from Pan Gongsheng from the PBOC. Do we need maybe some comments from President Xi Jinping?
Well, I guess it's always nice to see, a higher authority do these things, but we all know what China's like, and we all know that Mr. Pang would not have said what he did without the blessing from much higher up. So I think unlike many other situations in other countries in the world, we can probably take it that this comes from the top. The measures, I think, actually, I rather embarrassingly forecast them coming through in about February, and now they've come through sometime later. So, and they've come through at a measured pace. But I would say that this is a mid-level move. It's not the big bazooka, I think, that is probably needed, but it's certainly a step along the way. And I think that quite a positive sign for Chinese markets.
Does it cause you to maybe become a little interested in taking on risk insofar as Chinese assets are concerned?
Yeah, I think so, Doug. I think the situation is that we've seen China underperforming dramatically over the last few years, actually quite some years. And I think what we're maybe about to see now is that at least the market starts to bottom out. At least it stops underperforming other world markets. And that's a positive, because I think then investors, if they take that view, they can say, well, it's probably worth going in. We're not going to lose money against, say, an overall index. We're not going to underperform. And who knows, we may outperform because valuations are very low. It's a very under-owned market, and it is the second largest economy in the world.
It's kind of a double whammy to the positive side for Hong Kong. It's a small place, doesn't influence China as much as it used to. But with the Fed cutting interest rates by 50 basis points and then this, how does Hong Kong look to you now?
Well, I always see Hong Kong as an option on China. You know, when China does badly, Hong Kong does worse. When China does better, Hong Kong does better. And part of that is because, you know, we are a small microcosm of a sort of mix between China and the rest of the world, very internationalized city. But we are also the 14th largest city in China now, so we're sort of caught in between this. But I think one of the key things, of course, is we have our own currency, the Hong Kong dollar, which is linked to the US dollar, interest rates coming down there. So that's likely to be positive. Much of Hong Kong's wealth is tied up in property, and of course, that's an interest rate sensitive market.
So I'm curious about the themes that you want to tease out here. If you were to go long an asset right now, what industry or theme would it be connected to?
Well, if you're looking at China, I still think you have to look at tech, and there are a couple of reasons for that. One is that tech, after all, around the world is the darling of our age. You know, it used to be TV, it used to be steel, it used to be shipbuilding. Our age, tech is the darling. Of course, we're getting to the stage where you need to be relatively more careful where you look, but I think the tech sector in China is definitely a place to look. The other thing, too, is that there will be a lot of state support and state interest in the tech sector, and I'm talking about the commercial side of the tech sector, not just the military side, because of the sanctions process. And the sanctions process is likely to lead to much more interest in developing much more sophisticated technological solutions in China. And I think that that's going to be the kind of area that investors should be looking at first.
On the political side, what I was hinting at with the first question is whether or not we might see some comments from Xi Jinping about relations with the rest of the world, the conditions under which Hong Kong is operating, something like that. Any sort of political gesture that perhaps strengthens Hong Kong's semi-autonomy that, we've long been promised and seems to be eroding.
I don't think they're necessarily related. I think at the moment the administration is focused on the economy and how to get the economy back up to shape. I think political pronouncements are likely to come later at a different time, maybe associated with a new president in the US or new old president in the US, where clearly they're going to have to chat and if not make up, at least get to understand each other. So I think that's the sort of time when you might expect a political discussion to come out from China.
It's interesting you make that point. In my hands right now, I have the latest edition of Bloomberg Business Week, the hard copy. Story by our own Tom Orlick of Bloomberg Economics saying that Trump's tariffs would simply end trade with China. Full stop. Is that an exaggeration?
I think so. I'm very impressed, Doug, that you're still reading paper copies of everything. You're old school like me.
Old school. Yeah.
But I think no. I think what happens with tariffs, somebody's got to pay for it at the end of the day, and it's always the consumer. It may take a little while, but it's always the consumer. But at the same time, the consumer will still demand goods. There'll still be the law of comparative advantage still working. There'll still be trade. So I don't think we're looking at a complete cut-off in trade. And in any case, as we've seen with trade through Mexico, there are plenty of loopholes that this sort of thing, these sort of things can work through.
Sneak in a final one here, switching the attention to the U.S., the cutting interest rates by the Fed. Do you like the U.S. at the moment?
I do. You know, we're still in a situation where the consumer is fairly strong. We have to keep an eye on unemployment, but, unemployment's really quite low. The consumer's still ticking away. We're starting to get a little bit of weakness here and there, but yeah, I'm still holding the U.S.
Richard, thank you very much for joining us here. Good to see you back in town, and we'll have to get together soon outside of work. Richard Harris joins us, the CEO of Port Shelter Investment Management. Joining us in our Hong Kong studios is Daniel Tenke, Bloomberg Asia EcoGov Executive Editor, to take a closer look at this rollout of economic stimulus in China. Dan, thanks very much for coming in. So almost everybody is portraying this as a broad package of monetary stimulus. It seems to have caused a fairly positive response here. There are some questions about its sustainability, and there are also some questions about whether or not there is broad political support for this. So we'll keep the political part for perhaps a moment or two. Let's start off with, is this the kind of package that could work?
Well, certainly in the short term, it looks to be doing what policymakers intended it to do. The criticism up to now has been that measures have been very piecemeal, kind of, authorities waiting to see if they can actually hit this growth target that they set of around 5%. And what we've seen in recent weeks is a lot of downgrades from some of the big banks saying that, no, they're actually on track to miss that target. So this was kind of a bit of showmanship here from the PBOC and the financial regulators, all getting together at the same time and rolling out all of these measures all at once. So that's stunned the market a bit. It wasn't not normally the way that the PBOC operates, to come out and have the governor, take questions and announce rate cuts and RR cuts all at the same time, including more cash for banks, incentives to buy homes, stock stabilization fund. So all of these things have been called for, but the fact that they were like, hey, here we are, we're all together, we're taking this seriously, we're laying all these things out at the same time, markets loved that. They kind of soared in the aftermath yesterday. And now most economists, including Bloomberg Economics, is saying, yes, what they did on the monetary side is definitely enough to hit that target this year.
That's interesting. I was looking at research from Bloomberg Economics. You mentioned the fact that these measures were unveiled together, that being in and of itself unusual. But Bloomberg Economics was talking about the fact that it essentially speaks to the urgency felt in Beijing to head off deflationary risk. I mean, is that the big concern right now, is getting stuck in deflation?
Yes, that's the longer term concern. So what this package did was basically allowed them to hit that growth target this year. But the big looming question is, how are they going to stem this deflationary spiral? The GDP deflator has been negative for 4 or 5 quarters. That's the longest stretch since the early 1990s. And the consensus is basically that this is enough to hit the growth target, but it's not enough to bring back confidence more broadly in the economy. And that's what is going to be needed going forward.
Yeah, and that's what I was hinting at with some political support. And it's also noted in the China Today column that Pan Gongsheng did about all he can to help stimulate the economy. And now it's up to President Xi Jinping and the top political leadership to follow through. Now, I'm not sure what they mean by following through, but are there some other things that the political authorities can do to rebuild confidence in the electorate? Oh, I say electorate, but I mean in the populace.
The populace, yes. I think there was always a sense that the quickest way you could do this was on the monetary policy side. And the quickest thing you could do was lower interest rates and get more money flowing in the system. And that's what they did yesterday. We have reporting that President Xi and top leaders of the Communist Party in the past couple of weeks have held urgent meetings on the economy, and that this briefing stemmed from that. So they are feeling the heat in that sense. And now the spotlight goes to the finance ministry. What can they do on the fiscal side? And that's a much tougher question than lowering rates. That involves getting local governments to spend money, to find projects to spend money on. And that's not something that's easy to do in China right now. The other thing kind of handcuffing Chinese authorities is a reluctance to do what a lot of other governments do around the world, which is give cash directly to people. That's something that China just hasn't done before, and that the authorities don't want to do. They're worried about entrenching expectations among more than 1 billion people for welfare handouts, and basically creating a system of social spending that they can't afford over the long run. So what they're coming up with are kind of targeted measures that would allow people to be absolutely sure that they'll spend the money. I mean, China has one of the largest savings rates in the world. So the feeling is even if you give everyone $100, they're going to save most of that and not spend a lot of it. So that's the fear among policymakers in Beijing. Okay. How do we do that? How do we get people spending?
I think we can agree that one of the bright spots of the Chinese economy has been on the export side. And I'm wondering, with all the risk maybe that certain industries may be up against tariffs, whether it's EVs coming from the U.S., Canada, Europe, whether China's trading partners realize the vulnerability right now and will use that to their advantage in trying to negotiate better trade deals. Do you think that's a possibility?
I think as far as the whole plan for the Chinese economy and Xi's what Xi is doing is to double down on manufacturing and really pour money into that, particularly new productive forces is what he calls them. EVs, batteries, solar panels, that kind of stuff. That is really what is driving the economy at the moment. And they're trying to, what they did yesterday was trying to stop the bleeding on the property side in particular, which is a drag on growth. As far as the rest of the world, tariffs are probably the best answer. And we saw the EU doing that. We see Donald Trump threatening that in the U.S. But as long as China is producing goods at the quality and price that they're producing, a lot of consumers around the world are just going to buy those. And that is already spurring trade tensions along the way because, a lot of countries just can't compete with what China's doing on the manufacturing side right now. So the question is, okay, how do you stop that? And a lot of countries are moving to tariffs so that Chinese companies invest in those countries and put up factories in the EU and other places.
All right, Dan, thanks very much. Daniel Tenke, Bloomberg Asia, EcoGov Executive Editor.
So New York City, this is where the UN General Assembly is taking place this week. And when Antonio Guterres, the Secretary General, gave his opening address the other day, he spoke about a powder keg of risk engulfing the world, impunity and inequality and uncertainty. He went on to say that in recent years, the global situation is becoming intolerable and unsustainable. And he put it bluntly, we can't go on like this. Let's check in now at what is happening at the General Assembly with a Bloomberg managing editor for breaking news in South Asia. Derek Wallbank joins us from our studios in Singapore. Derek, thanks for making time to chat with us. One of the things that I think is on the top of many people's minds, the wars that are raging in the Mideast, Ukraine and Sudan, right?
Yeah, I think that's exactly right. And indeed, those conflicts dominated a lot of the proceedings at the United Nations, from Joe Biden's remarks that you mentioned to remarks from Iran's new leader to remarks from Turkey's Erdogan. We were hearing about these conflicts laced through with questions about how they come to a resolution, as well as a little bit of introspection in terms of how the UN itself is able to engage conflicts at this stage. I mean, look, it's no secret that in two of the main conflicts that we've got going on at the minute, and I'm thinking specifically about in the Middle East, and I'm thinking specifically about Russia and Ukraine, they involve in the Russia-Ukraine situation a country that has a veto on the UN Security Council, and in the Israel-Hamas and Israel-Hezbollah conflict, it involves a country that has an almost protecting power in the form of the United States to Israel that has a veto on the UN Security Council. And so I think there is a lot of mounting frustration at that body and at that body's inability to be able to, in some way structurally, take on some of the world's biggest problems.
Well, Derek, for President Biden to call for constructive coalitions would suggest that there's some duress there. And it doesn't seem like there's really too much duress in the coalition against Russia on its actions in Ukraine. But certainly with Israel, that would seem to be a problem area. I mean, it's not a huge coalition. It's basically Israel and the United States. But is there a real issue there that the U.S. is concerned about?
Well, I think that when I hear Joe Biden speak in those terms, one of the things I think he's speaking about is to the future as well, right? You know, there's a lot of question about what sort of United States the world is going to be dealing with after the next election. I happen to recall 25 years ago, we'd have American presidential elections, and the question, and it would be, these are two sides of the same coin. It's basically going to be the same U.S. foreign policy regardless of who wins. That's really not the case right now. Kamala Harris and Donald Trump have very vastly different visions for what they would do on the world stage, even if parts of that may overlap. Ukraine may be one of the biggest difference points between them. And so I do think that when Joe Biden is telling the world that they need to stand with coalitions, he is also somewhat speaking into the mirror of his own country.
Yeah, we heard, as you mentioned, from Iran's new president, Masoud Pezeshkian, accusing Israel of seeking a wider war. And he went on to say the attacks in Lebanon recently on the targets of Hezbollah cannot go unanswered. Later in the week, we're going to hear from Mahmoud Abbas, the Palestinian president, and I think on Friday, Benjamin Netanyahu, the prime minister of Israel, will be speaking as well. So this is, in my mind, just going to kind of lay bare a lot of where these animosities lie and the degree to which this conflict right now is at a rolling boil.
Well, yes, and I think one of the biggest questions here is how do you kind of contain and how do you draw a line under and get to a point where there's not guns and bombs and explosions and things of that nature. And that's really what Joe Biden was trying to try and find a path toward. It's a very difficult thing to do. The leader of Iran will be well aware that in Israel's retaliation with the exploding pagers and things against Hezbollah, that Iran's own ambassador was injured in that. Israel draws a logical inference therefrom, and there's really, we've got in this sort of situation a lot of kind of proxy conflict, which is in some ways a very difficult problem to unwind, because as Iran will say, its proxies do not necessarily seek its permission to do what they will, and so how do you stop a thing that a conflict that is operating both obviously and also in diplomatic gray zones? That is a very, very complicated thing on top of the Mideast's already complex histories.
And briefly on Ukraine, Volodymyr Zelensky will meet Biden on Thursday and also Harris with a victory plan to end the war. In 30 seconds, what might that be?
Well, I think that, again, we'll see what he has to say, but I think that the big question that he has in his mind right now is what is a durable strategy that can shore up support, both from the U.S. and from the rest of the world, to hedge against whatever is going to happen in the U.S. political election.
Derek, always a pleasure. We'll leave it there. Thank you so much for making time to chat with us. I know it's a busy week for you. Derek Wallbank, he is a Bloomberg managing editor for breaking news in Asia South, joining us from our studios in Singapore, helping us understand what's been happening this week as the UN General Assembly meets in New York.
This is the Bloomberg Daybreak Asia podcast, bringing you the stories making news and moving markets in the Asia Pacific. Visit the Bloomberg Podcast channel on YouTube to get more episodes of this and other shows from Bloomberg. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen. And always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.